Welcome to Breaking News to Trading Moves. Imagine you are building the most expensive, advanced highway system in human history.
Right, like a massive infrastructure project.
Yeah, exactly. Now imagine the company supplying all the specialized concrete suddenly says, well, actually, we might not need to pour as much in 2027 as we originally thought.
Oh, wow. That would definitely cause some panic.
Right, and that is exactly what just happened in the AI market. We are looking directly at Broadcom today. The headline here is a recent, very sharp sell-off for the company, and it was triggered by a revenue miss.
Yeah, that miss really caught people off guard.
It did, but the real pain point for investors wasn't just the miss. It was that Broadcom did not raise its fiscal 2027 AI revenue forecast.
Which is wild to think about, right? Broadcom trades under ticker AVGO, and to really understand the reaction, you have to look at what they actually do.
Right, because they aren't just selling like a random piece of software.
No, not at all. They are an absolute pillar in custom AI chips, high-speed networking, and cloud data center operations. I mean, they are not just selling a single component.
They're supplying the wiring, basically.
Exactly. They're supplying the critical wiring that allows these massive server farms to even function. So when a company's sitting right in the middle of that physical infrastructure, misses expectations.
And decides not to raise a forecast for literally 3 years down the road.
Right.
The market notices immediately. Capital just starts moving.
So our mission right now is to look at that headline and break down the specific winners and losers emerging as the market gets much stricter with AI stocks.
It's definitely getting stricter. The free pass is over.
It really is. The environment right now, for you listening, it feels like a college professor grading on a much tougher curve than last semester. You have to clearly show all your math to get an A.
Yeah, you really do.
You cannot just write down the acronym AI on the whiteboard and expect full credit anymore. The syllabus has completely changed. I mean, during the initial phases of the AI hardware rollout, simply announcing a product loosely related to a data center was usually enough to satisfy Wall Street.
Right, the stock would just pop instantly.
Exactly. But now, the grading curve requires concrete proof of future cash flows. And Broadcom has been a clear beneficiary of this infrastructure boom because they are thoroughly integrated into how data centers operate.
So their guidance is basically a weather report for everyone else.
That's a great way to put it. Their guidance for 2027 acts as a barometer for the broader hardware sector. The moment they decide not to raise that distant forecast, traders instantly start recalculating the entire ecosystem's growth trajectory.
Okay, so let us examine the companies taking direct hits first. Because Broadcom missed expectations, we are looking at the companies in Broadcom's immediate vicinity.
The neighbors, basically.
Right, the other custom chip suppliers and broader semiconductor peers who are taking the most direct pressure.
Well, the most immediate pressure lands right on Marvell Technology. That's ticker MRVL. Investors frequently group Marvell together with Broadcom.
Because they play in the same sandbox?
Exactly. They're both viewed as primary beneficiaries of custom chips and AI infrastructure. But, to really grasp why Marvell takes a hit, we need to clarify what makes a chip custom in the first place.
Let us pause there and explain the mechanics for a second. What is the actual difference between a custom chip from a company like Broadcom or Marvell versus what Nvidia sells?
That's a really common question. The industry term is an ASIC, which stands for Application-Specific Integrated Circuit.
Okay, ASIC.
Right. Unlike a general-purpose processor from Nvidia that can handle a wide variety of AI tasks, a custom chip is designed from the ground up to do one highly specific job.
Just one job.
Just one job for one specific customer, but it does it incredibly well and with extreme power efficiency. Google, for example, uses custom chips specifically for their search algorithms.
Oh, I see. So the market assumed that demand for these highly customized chips would just grow on a perfect, uninterrupted upward trajectory.
Yes. Investors price that hardware for absolute perfection. So when Broadcom's report implies that the trajectory might not be flawless, the market immediately looks at Marvell, who operates in that exact same custom lane.
They just apply the exact same skepticism.
Exactly. Traders are wondering if the peak growth rates for specialized silicon are already behind us.
Wow. And the sentiment damage definitely does not stop at custom silicon. It bleeds directly into the wider sector. We're looking at a broader list of semiconductor peers taking a hit on this news, too.
Yeah, the splash zone is quite large.
We have Micron Technology, ticker MU, which is tied to memory demand. We have Qualcomm, ticker QSOM, which is heavily diversified but still trades with the overall chip sentiment.
Right, they all get pulled down.
And Intel, ticker INTC, which is already under pressure while attempting to rebuild its position in advanced chip manufacturing. Let's start with Micron.
Let us take Micron as the prime example of how this bleeds over. AI data centers require massive amounts of high-bandwidth memory to feed data into the processors.
Okay, so how does that work in practice?
Well, think of an AI processing center like a massive factory. The processors are the workers on the floor, but Micron provides the conveyor belts.
Ah, I like that analogy.
Yeah, and if the conveyor belts are too slow, the workers just stand around doing nothing, which wastes money. That is why high bandwidth memory is absolutely critical.
So if traders assume a slowdown in Broadcom's custom chips, they think the whole factory is slowing down.
Exactly. They assume it points to a broader slowdown in data center buildouts, so they will sell Micron, assuming the demand for those memory conveyor belts will also cool down.
Wait, let me pause you there. I have to push back on the market's reaction here.
Sure.
If I'm an everyday investor holding a diversified portfolio, I am watching Qualcomm lose ground because of a custom chip issue at Broadcom.
Right.
But Qualcomm is heavily focused on mobile phones and consumer devices. Is it completely rational for investors to penalize a highly diversified company like Qualcomm or a memory-specific company like Micron just because a single custom chip maker missed a distant 2027 forecast?
It seems crazy, I know.
Are we just throwing the baby out with the bathwater here?
Well, rationality takes a backseat to market structure in the short term.
Yeah.
Markets trade in massive baskets.
Baskets, right, like ETFs.
Exactly. Passive index funds, sector ETFs, and algorithmic trading models group these companies together under the massive umbrella of semiconductors.
So the algorithm doesn't care about mobile phones.
Not at all. When an algorithm sees a primary infrastructure player like Broadcom stumble, it systematically reduces exposure to the entire basket.
Yeah.
It does not pause to read the nuances of Qualcomm's mobile device revenue. It just sells the sector.
Wow. So Qualcomm has a massive footprint in mobile, but it just cannot escape the gravity of overall chip sentiment.
Exactly.
And Intel is arguably in a much tougher spot when that blanket selling happens, right?
Intel is in an incredibly vulnerable position right now. They are undertaking a highly capital-intensive turnaround to rebuild their advanced manufacturing capabilities.
Like literally building multi-billion-dollar factories.
Yes, to try and catch up in the fabrication race. Any cooling of overall sector sentiment hits them particularly hard because their margin for error is razor thin.
They need cash, basically.
They need cheap capital and eager investors to fund those factories. So when the semiconductor basket gets sold off, Intel feels the pain acutely.
That brings us to a really compelling group of stocks. After looking at the clear losers, we have a group of hardware companies caught right in the middle.
Yeah, this is where it gets tricky.
It's a double-edged sword. These high-valuation AI hardware companies could be categorized as winners or losers entirely based on how the market decides to interpret the Broadcom news over the coming weeks.
This is where trading requires strict attention to detail. We're looking at names like Super Microcomputer, ticker SMCI, Dell Technologies, ticker DLL, and Arista Networks, ticker ANET.
Okay, let's break that down. Let us establish the bear case first.
Sure. If investors view the Broadcom sell-off as a broader AI valuation reset across the board, server and networking stocks will fall alongside them.
That makes sense.
The logic holds up, right?
Yeah.
If the whole AI infrastructure build-out is slowing down to catch its breath, the companies selling the physical metal server racks and the networking switches are going to see their order books thin out.
But there is a completely opposite way to view this, which is the bull case.
Right. There's always a bull case.
If the market views Broadcom's miss as a company-specific issue, then Dell, ticker Dell, and Arista, ticker ANET, actually become clear winners as the real AI infrastructure names.
Because AI demand does not simply disappear.
Exactly. Data centers still actively need networking, servers, storage, and infrastructure to function. Arista is intrinsically linked to high-speed networking for cloud workloads, and Dell is deeply tied to enterprise servers.
Yeah, I mean, AI models still need to be trained, and enterprise companies still need to deploy AI applications for their workforce. That requires physical, heavy hardware.
So they can't just stop buying.
No, they can't.
Right.
If Broadcom's specific custom chip forecast was a bit conservative, a corporate IT department is not going to suddenly cancel their massive server upgrades with Dell. They still need the computing power.
And what about Arista?
Well, Arista Networks provides the specialized Ethernet switches that allow thousands of processors to talk to each other simultaneously. When you have a cluster of 10,000 GPUs trying to train a model, the traffic coordination is a nightmare.
Oh, I bet.
Arista acts as the traffic cop. That networking requirement remains absolute, regardless of what Broadcom expects to make in 2027.
Think of it exactly like a massive construction project. For you listening, if you are building a house, you might cancel your order for a very specific, expensive smart home wiring system.
Which represents Broadcom's custom chips in this scenario.
Right. But you still absolutely need lumber and plumbing to finish the house. Dell's servers and Arista's networking gear represent the lumber and the plumbing of the data center.
That's a really good way to visualize it.
But here is the challenge for the everyday investor.
Yeah.
How are you supposed to tell the difference between a company-specific problem at Broadcom and a sector-wide valuation reset in real time?
You have to look at the underlying capital expenditures of the biggest buyers. And you watch closely for where the capital rotates.
So follow the money.
Always follow the money. When money leaves a massive company like Broadcom, institutional investors rarely just sit on cash. They rotate that capital to other areas of the exact same theme.
What would a sector-wide reset actually look like then?
A sector-wide valuation reset looks like aggressive selling across every single technology name with zero discrimination, coupled with the big cloud providers actually going on record to announce cuts to their capital spending.
And we aren't seeing that right now.
We are not seeing that at all. What we are seeing looks exactly like a company-specific adjustment. Money is moving away from custom silicon and rotating directly into broader AI platforms and the big hyperscale buyers.
Which perfectly sets up the beneficiaries. Since AI demand isn't vanishing, the capital pulling back from custom chips is rotating elsewhere.
Yes, it has to go somewhere.
Let us look at the AI accelerator leaders catching that capital right now. Nvidia, ticker NVDA, and Advanced Micro Devices, ticker AMD, both stand to benefit in this rotation.
The market naturally returns to companies with broader, proven AI platforms when uncertainty hits a niche area. If investors become more cautious on custom AI chips, they seek the safety of the established, generalized platforms.
And Nvidia is the king of that, right?
By a wide margin. Nvidia remains the clearest leader in this space. They do not just sell a single chip. They sell a turnkey ecosystem.
So you buy into the whole package?
Exactly. They possess the GPUs, the networking hardware, a proprietary software layer that developers are essentially locked into, and remarkably strong relationships with every major cloud customer on Earth. It is a complete package.
Right. So when custom silicon looks slightly risky or overpriced, buyers and investors default to the proven out-of-the-box ecosystem.
Yeah, it's the safe bet.
But AMD, ticker AMD, catches a tailwind here as well, right?
Yeah.
Because customers are actively looking for alternatives to Nvidia to ensure supplier diversity.
Oh, absolutely. If you are managing procurement for a trillion-dollar technology company, your worst nightmare is being entirely dependent on a single vendor for the most critical component of your future business model.
You'd have zero leverage.
None. You desperately want alternate suppliers to succeed. AMD provides a highly capable alternative to NVIDIA's hardware.
So as capital rotates away from the specialized custom chip makers, AMD benefits.
Yes, they benefit from cloud providers who want high-performance accelerators, but absolutely need to maintain leverage by keeping multiple suppliers in the game.
That concept of leverage brings us to the biggest players on the board, the hyperscale AI buyers. We are looking at Alphabet, ticker GOGL, and Meta Platforms, ticker Meta.
The giants of the industry.
So we throw the term hyperscaler around a lot, but for you listening, we're basically talking about the absolute titans of the cloud. The companies buying servers not by the individual rack, but by the entire warehouse.
And these hyperscalers are spending tens of billions of dollars on AI hardware. But, they possess immense bargaining power because of their sheer size.
Because they buy so much.
Right. When investors start questioning how much profit the chip suppliers can actually capture moving forward, Wall Street's attention rotates back to these biggest AI buyers.
Let me ask you this then. If hyperscalers like Alphabet and Meta hold all this bargaining power, do they actively benefit when custom chip suppliers like Broadcom stumble, simply because it gives them more leverage in pricing negotiations?
That is exactly what happens. The relationship between the chip suppliers and the hyperscalers is a constant, brutal tug-of-war over profit margins.
I can only imagine those boardrooms.
Oh, yeah. Alphabet and Meta are ordering hardware at a scale that literally dictates the quarterly revenues of the suppliers. If a supplier like Broadcom shows any weakness, or if the market decides the suppliers are losing their unquestioned pricing power,
the hyperscalers just pounce on that.
they are the direct beneficiaries. They can demand bigger terms, lower prices, or more customized features without paying a premium.
So traders realize the value is just shifting across the table.
Right. Traders realize that if the hardware vendors are facing margin pressure, the massive buyers sitting on the other side of the negotiating table are likely capturing that exact value.
And they can always just build their own, right?
Furthermore, yes, Alphabet and Meta have the engineering talent and the capital to just build their own internal silicon if external suppliers push too hard on pricing. That gives them an almost insurmountable negotiating position.
Pulling all these winners and losers together gives us a very clear picture of the current landscape. We are moving away from the initial euphoria and settling into the cold reality of business operations.
The honeymoon phase is over.
It really is. We are looking at a market that wants proof.
And that's the primary takeaway from the Broadcom news. It is not that the AI boom is over. The technology is still deploying at scale, and the data centers are still being built.
Right, the concrete is still being poured.
Yes, exactly. However, investors will no longer reward every AI-linked company automatically. The market is demanding stronger numbers, better guidance, and clearer evidence that AI spending can keep growing at a pace that justifies these high valuations.
You can see exactly what the market is doing here. A company cannot just issue a press release with the letters A and I anymore.
No, that won't cut it.
They need the cold, hard balance sheet to prove the revenue is real and sustainable over the next 3 to 5 years.
For traders, this highlights an important transition phase. While AI remains a major market theme, trading within the sector is becoming far more selective.
You have to do your homework now.
You really do. You have to look closely at the mechanics of each business. You have to identify whether a company holds true pricing power against the hyperscalers, whether they provide a vital, irreplaceable infrastructure component like high bandwidth memory or networking switches.
Or whether they are simply riding the coattails of the broader hardware sentiment.
Exactly.
The strictness of the public markets right now is fascinating to watch unfold. And I want to leave you, the listener, with this thought. If public markets are now demanding concrete proof and strict revenue forecasts for years as distant as 2027, how will this new strictness alter the way private early-stage AI startups are valued and funded before they ever reach the public stock exchange?
That's a great question.
Right. If Wall Street is demanding perfect execution from a giant like Broadcom, the venture capital world might start asking for a lot more than just a slick presentation from the next generation of AI founders.
This is not financial advice or buy or sell recommendations. This is purely the opinion of the author.